Come to order. This is the Retired Employees Healthcare Benefits Trust quarterly meeting. I'm Treasurer Michael Shostak. I welcome you to today's meeting. Let's begin with the Pledge of Allegiance. I pledge
allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. I note for the record that we have co-trustees Chris Kalinsky and Jason Tice here, so we are all in attendance. I'm going to open the floor for public comment. If anyone from the public wishes to address the committee, now's your time. Seeing none, I'm going to close public comment. I'm going to move on to item 4, approve the minutes of the August 6, 2025 committee meeting. They've been released in the packet. Are there any suggestions or motions?
Motion to approve the minutes.
Support.
Okay, we have a motion and we have support. All those in favor say aye.
Aye.
Opposed? Okay, those pass. We move on to item number 5, our quarterly portfolio review. And here we have Mr. Brian Green from Mariner Institutional.
Excellent. Thank you, Mr. Chairman. So for those of you that I've worked with for a number of years know, and I always feel like you kind of reach that point in your career when three things happen. Number one, people younger than you retire. And I marked that in Ypsilanti about a month ago when a police officer was 45, retired. And I'm like, you're legitimately younger than me. Now, I was definitely not done working, but had a 25-year career in law enforcement. So it's right pivotal moments when people younger than you retire, which is to be celebrated. That's the entire reason we're here. When people start giving your sayings back to you, and that was, your Michael, your predecessor. My analogy was like cracks in the windshield, and Brian threw that back at me a couple times. I'm like, I feel like I've heard that a few times. And then the third is people that you've worked with long enough are like, you brought in charts and graphs, that means you have bad news. Because typically we use colorful charts and graphs to distract you from bad news. And I don't have bad news. I have good news. I don't have great news. I have good news. But the charts and graphs are kind of a way of explaining why I have good news, not great news, because it's been a fabulous market so far this year. But if you have revenue, it hasn't been a great time for you. And if you have profits, it hasn't been a great time for you, which is a tremendous irony from the standpoint of saying what we should have bought on January 1 was just the worst companies that are publicly traded in the U.S., ones that have no revenue, ones that make no money, ones that literally just hemorrhage cash on a daily basis. Buy those stocks, and you're going to be really happy with your performance so far this year. So before I go into the book, I'm going to go to the extra handout, and credit to Schroders. This is from their quarterly market update. I'm going to make you jump a little bit, but kind of working from left to right. If you look at the NASDAQ, so this is Jan 1 through September 30th. If you are a publicly traded U.S. company that trades on the NASDAQ, so 4-letter ticker, and you have no revenue, you're up 34. That basket of stocks is up 34% this year. If we stay in the NASDAQ and say if you are unprofitable, so if you are losing money, you're up 18% so far this year. If you have positive revenue and you trade in the NASDAQ, you're up 11%. And if you're making money and you trade in the NASDAQ, you're only up 7%. So, don't sell anything. You're up 34%. Sell things and sell them at a profit, you're up 7%. Looking at the S&P 500, right? S&P 500 isn't just the 500 largest stocks in the U.S. It is the 500 largest stocks that meet certain quality requirements. That's why Tesla for a number of years wasn't in the S&P 500, yet when it joined and met the qualifications, it was suddenly a top 10 holding. Those are the names we hold in the Fidelity Extended Market Index Fund. So that is the entire U.S. equity market minus the S&P 500. So there are some large cap names in there. If you own the Magnificent Seven, that basket is up 18% so far this year. If you own the S&P 493, which is the 500 less the Mag 7, you're only up 8%. And here's where it gets wilder. In small mid-cap world, so this is going to be the Reinhardts of the world, Clarkston that has since been terminated, or the Fidelity Extended Market Index Fund, if you are an unprofitable, publicly traded company that is a small and mid-cap stock in the U.S., so think somewhere in the neighborhood of a market value between like 500 million and maybe 30 billion, unprofitable, you're up 12% so far this year. If you're profitable, you're making 5%. So I use this to kind of lay the groundwork for, normally when we walk through the book, we talk through, hey, Ancora outperformed, underperformed, and it's because of these names. For this quarter, from a preparation standpoint, I didn't even go into, did you own JP Morgan or did you own enough, Apple or Netflix or Tesla? What it comes down to, plain and simple, is, if I look at the third quarter, for example, 91% of active small cap managers underperformed. And I don't have to look at individual names. I just have to look at this and go, if as an active manager, you made the choice to buy companies with revenues and earnings, forget everything else, right? Moats, great management teams, like all of the things that make a successful business, but just drew the line as, are you selling things and are you making money when you sell those things? And we bought that stock versus don't sell anything and lose money. The difference in performance was 7% for the year. Like literally the choice to choose to buy profitable companies meant you were 7% behind the rest of your sphere, or right, the pond you can fish in from a stock picking standpoint, like the Russell 2000. If you picked the 200 names that were profitable and skipped the 1,800 that weren't, you underperformed by 7%. No other decision. So that's just kind of the headwind that active managers have faced in calendar year 2025. This is through September. October is just as bad. October was just as bad in terms of the disparity between unprofitable and profitable companies and the performance that we've seen. So, jumping into the book, page 1, right? I mentioned I have good news, not great news. Good news from the standpoint of well into positive territory. But good versus great, the difference is positive versus outperforming. You look at it on a calendar year-to-date basis, for the quarter, S&P's up 8, it's up almost 15% for the year. Small cap stocks, that would be the Russell 2000. We did see a big swing in the quarter where large cap stocks just cooled off a little bit. Still, up 8, but small cap stocks were up 12% for the quarter, still only up 10 for the year. And the darling continues to be dominance from an international equity standpoint. While U.S. markets outperformed international in the third quarter, developed international in the third quarter, developed international up 4.7, up 25 for the year, and emerging markets continues to be the big story, up 10% for the quarter and up 27.5%, now pushing 30% so far for the year. So, big gain on things from an international equity standpoint so far for the calendar year. Fixed income, news lately obviously has been a couple cuts from a Fed standpoint. Obviously, that's going to impact short-term bonds, right? The bond market, once you get past really kind of 3 to 4 years, doesn't really care what the Fed says, right? It's really a predictive element, right? The Fed can't control the 10-year. That's going to be market dynamics and what's going on. So, much to the chagrin of a lot of real estate investors or anybody that's purchased a house in the last couple of years, long-term rates have continued to stay high. I always think it's funny when you get that Yahoo Finance alert, 30-year fixed is the lowest it's been, is that it's, 12-month low. And I'm like, well, I think that's still somewhere in the neighborhood of 6.5%, which is pretty expensive considering, right, it's still where are you at? 2.8, I'm at 3%, I'm at 3.5, from just a couple of years ago from a home purchase standpoint. So the backdrop, as I'd mentioned, from an overall market standpoint is great news. But because of market dynamics that we saw in terms of are you making money or are you losing money, and despite logic thinking profitable companies should do better, that's not what we've seen so far this year. So if you flip to page 3, talk about overall results. The overall Ontario Healthcare Trust up 5.4% for the quarter. To think about this, right, we're 9 months into calendar year. Dunkin' Donuts has switched to Christmas cups. I was laughing this morning when I stopped at the one on Woodward in Birmingham, and they were literally decorating for Christmas. I'm like, can we get to Thanksgiving? So 9 months into the calendar year, 6 months into the fiscal year, on a fiscal year basis, halfway through up 12.1, lagging the policy index is up 14.6. Kind of focusing on that quarter, was right. I just went through all of this in terms of if you own profitable companies, you're expected to underperform. Wasn't the case necessarily in large cap value. We saw Ancora outperform. You see up 6.2 versus 5.3. For them, it was more of kind of AI-related stocks, like Broadcom has been in that portfolio for a long time, which has always been viewed, to quote David Sowerby, it's the poor man's NVIDIA. Fidelity S&P 500 index, surprise, surprise, should be up 8.1, and it was up 8.1. Reinhardt underperformed. And again, this is where, from a traditional standpoint, I'd comment on, they were overweight financials, they were underweight consumer discretionary, and it wasn't a name. It wasn't a sector. It was the choice to purchase companies that have positive revenue and have profitability that cause them to underperform. So it's not what they own, it's what they didn't own. And candidly, we spent more time in October and this first part of November digging through small cap portfolios that outperformed, because that tells us that if you tell us, right, my focus is on buying high quality companies with revenues, with profitable earnings, and you own names like, BETR, that's an AI-focused mortgage originator, and the stock was up 350% for the quarter, yet it has negative earnings and negative revenue. It's grounds for termination, right? Great job outperforming, but you didn't follow your investment philosophy and bought names that wouldn't meet any type of quality screen. Fidelity Extended Market Index, as I'd mentioned, the complement to Reinhardt, much the same as we have the S&P 500 index, or a passive exposure from a large cap standpoint. We have a passive exposure from a small cap standpoint that dramatically benefited the portfolio because it just owns everything. So those names that just absolutely ripped in the quarter were some of the top names in this portfolio. From an international equity standpoint, as I'd mentioned, Fidelity International right in line. Vanguard Emerging Markets up just over 10% versus benchmark up 10.6. Baird, small allocation here, right in line. Seems hard to get excited about a 1.6% return, and we just talked about 6, 8, 10% returns, but still kind of a necessary part of the portfolio just because of the limitations we have within Public Act 314. And then we have some zeros, not because there's no returns, not because they were up 0, but just from a timing standpoint, we don't have those numbers in yet. And the final piece that I'll leave you with is, as I'd mentioned at the last meeting, we're waiting on pricing to come in with Capital Dynamics. That is the private equity secondaries portfolio that was added. So they are out buying existing interests in private equity funds. They are not investing in a private equity fund that is putting new dollars to work today. They're going out and saying, XYZ endowment, you want to reduce your private equity exposure, we'll buy what you have, assuming it's high quality, and we will buy it not at 100 cents on the dollar, but we'll buy it at 70 cents on the dollar or 75 cents on the dollar. So that portfolio, started back in October of last year. We think we're about 40% deployed. It's up 30% out of the gate. Now, I would expect that number to come down a little bit, right? The goal here is kind of mid-teens return over the life of it. But you get that initial pop right out of the gate with funds like this because, as I'd mentioned, right, fair market value pricing is 100 cents on the dollar, but because you want to sell an illiquid investment, I'm not going to pay you full price for it. I'm going to pay you 70 cents for it. Well, if I bought it at 70 and last quarter is worth 100, just because I bought it at 70, right, once I reappraise it, I get that immediate pickup. So, nice boost in returns. Implemented one change working with Michael. End of October, we funded an allocation to a small cap manager called Siegel Bryant Hamel. Team's based in Chicago. That was funded through a reduction in, a little bit of a reduction in large cap, kind of brought that back in line with its long-term target, and then pulled money out of that Fidelity Extended Market Index Fund. So when Clarkson was terminated, those funds were largely allocated to the index fund just to keep the small cap exposure the same. And then we're working through and trying to find a good complement to the Reinhardt portfolio. number of candidates considered, had a lengthy conversation and, presentation and meeting with lead portfolio manager and assistant portfolio manager, was that about 3 weeks ago? Worked through the contracting process, and then everything was open and funded, both on the retiree healthcare and on the pension side, and went live on Halloween.
Thanks, Brian. Do you want to skip to page 6, the allocations?
Sure. So, the way this looked at the end of September, just from a visual standpoint, we were at 36% in U.S. large cap exposure versus a 30% target. And we were underweight in small and mid cap. With the rebalance that we did, working with Michael and his staff at the end, near the tail end of October, these numbers would all be right in line with target. So, large cap domestic equity is right in line with this target of 30%. Small mid cap is right in line with this target of 25%. International is at 15%. So we use that as an opportunity to rebalance the portfolio and bring everything back in line with this long-term target.
The areas that we're going to remain under our target are real estate and alternatives, because those are more private allocations, and we don't have the room to make another meaningful allocation, so those will stay below their target, right?
Correct. And it's actually been beneficial, right? We're underweight those, so I just go back to, two things happen. Getting used to reading glasses. This is the other part of celebrating your mid-40s. Right, if we said no to alternative investments, that money has to go back into equities or fixed income. But even if we said yes to alternative investments, things like capital dynamics, as I'd mentioned, we make a commitment and that gets deployed over time, rather than just parking that dollar amount that's going to go to work sitting in cash. We have it working in the rest of the investment portfolio. So it was in the S&P 500 that was up 8%, or in Vanguard Emerging Markets that was up 10%. So even though it's been, I'm not going to use the term slow, I'm going to say measured deployment, because they're not just going to put all the money to work just to put it to work. They earn a percentage of the profits of the overall portfolio, so they want to be successful. As that is a measured deployment over time, we'll use that as a mechanism of rebalancing. So the portfolio has benefited so far this year from being underweight alternatives, but continue to working towards getting that closer to target.
Right, so the target will be when we are fully, they're not going to fully call our capital that we committed, but they'll call about 70% of it.
Correct.
So we'll get much closer to that target of 10%. We may not hit it, but we'll be closer to it. So we're not looking to make any other allocations to alternatives in this portfolio or in real estate. So we're good there. And we're trying to keep the cash as low as possible, of course, and keep it invested and working in the portfolio. So any questions for Brian?
No.
Okay. Then in terms of our allocations, this would be the meeting that we would typically make a recommendation to the Board of Trustees if we wanted to change our schedule of allocations. Right now, we're focused, as Brian was saying, we got 30% target for large cap, 25% small and mid cap, 15% international, 10% real estate, 10% alternatives, and 10% fixed income. We have to keep fixed income in the portfolio because we have to keep equity less than 70%. Because of Act, what is that, 345?
314.
314. So because of Act 314, we have to keep equities below 70% or no more than 70%. So with real estate at 10 and alternatives at 10, we have to have another 10% allocation. So we've got that fixed income allocation in there as well. So I'm not looking for any changes. Does anyone want to discuss making any changes to our allocations?
Nope.
Okay. Okay, so moving on, then, item 7 on the agenda, I have titled Committee Consolidation. I'd like to fold this committee into the Financial Sustainability Committee, so we can have one meeting, we can address both portfolios, the pension portfolio and the retiree healthcare trust. Jason and I already sit on the Financial Sustainability Committee. Neil would be the trustee representative. I'm going to probably take it to the board to make sure that they're okay with that. But I'm looking for a recommendation from this committee that's what we want to do. So, any thoughts or questions?
Yeah, I think it's a good use of people's time, as well as, obviously, they have some similarities in terms of their investment strategies and the investment vehicles we're using. So having multiple meetings kind of seems redundant. And there are multiple people on that committee that are very smart in finance and have the acclimate and the education in order to speak intelligently to it. I think it would be a good use of everybody's time and exposure to the other committee to have this access to this money as well.
Yeah, just oversee both, you know,
Yep.
have advisory
Committee.
body over both of them. Jason, thoughts?
I think it makes sense. Like you said, redundancy, gets efficiency, better use of everyone's time, Brian, and, yeah, whatever I'm sure the attorney will have to look into the aspects of that, how the original RHC was formed and whether it can merge in or not, but I think we can make
I
it
mean,
work.
we'll probably still stay as the trustees of the trust, but we don't necessarily have to meet in a separate meeting like this. That's what I want to look at, so. But
Yep.
I'm guessing we'll still stay as the trustees, so. Okay, I don't think we need any kind of motion or resolution on that. I think we have consensus. So unless there are any questions or comments, I look for a motion to adjourn.
So moved.
Second.
All right, we are adjourned.